So let's jump in. We've got the 2022 tax provisions coming out. They're all over the place. Everybody has a say. And as you know, we had a wonderful run with President Trump's provision in 2017. I was personally extremely happy with it. I thought it gave something to everybody. The corporations ran on a 21% corporate bracket. We had pass-through income exemptions. We had a much higher standard deduction. We lost a couple of things, but in most cases, the provisions under the standard deduction satisfied many, many people. So here we are, new administration, and we get this. And I wrote in a blog, which I'll put in the link, about really how the U.S. government really does not really care how many times they change it. But think of all of us who have to recreate our estate plans and pay those costs. So I get a little upset with that, but there's nothing I can do. It's the same old story, but we have to deal with what we have to deal. So I'm going to take you through what I'm seeing. Now, remember, I'm only showing you what I'm being told, and these are only proposals and suggestions and things of that nature. So let's take what's going on and what I see. I'm going to go down the list. The income brackets will go from 37 high to 39.6. Doesn't sound like a lot, but 2% on $1 million of taxation is a lot of money. Capital gain could end up being as high as 37% with people with high incomes. They're talking about $1 million plus of adjusted gross income. What I don't like about this bill is it gives the government the camel's nose in the tent. And yes, they want to tax at $1 million and up, and everybody who's under that says, okay, let them do it. I personally believe that the rich do pay their fair share, considering they pay a tremendous percentage of the taxes. But that's only my personal opinion. What I don't like about this is, especially on the Democratic side, is this is the nose of the camel in the tent, so that in the future years, they come down and lower this down to 300, 200, whatever it might be. But it is what it is. Corporate taxes, 28. You may not think that's a big deal, but if you run a corporation, that is a big deal. That's 7% out the window that's going to non-productive areas like the federal government. Redefined capital gains transaction, 37%. This is big for many people. Imagine you bought a building in 1960 for $100,000 and it's worth $4 million now. And now you have to pay the capital gains under a certain trigger, which I'll cover. Wow, that's a big hit. The exemption credit, which is the credit you get from the government when you pass or gift property, and it's set to sunset in 2026 on its own and revert back with a lower exemption credit. It's currently around 11,700,000 per person, with a family situation that's over $23 million of property to pass. There's no mention of the amount that it might sunset to. The Biden administration is big on doing something with this, but they haven't come out with it. Pass-through income subjected to payroll. This is huge too. If you're an S corporation or maybe a partnership, you set in motion your withdrawals and your salary as an S corporation, and you pay taxes and payroll. What's left over is profits, which you get taxed on, but it's not considered and defined as payroll taxes. Well, now what they want to do is, under certain situations, that profit now becomes what they call either a payroll tax, or they'll redefine it as a net investment income. I'm not quite sure on that part of it, but that's the term they use. There'll be more, that's big. That's usually, that's a big thing, because let's say you have an S corporation and they keep, they take $100,000 out in salary and they leave the other $300,000. Well, they're still paying taxes on that, but that's going to be used to build up their company, but they're going to pay income taxes on a personal level. It's going to be allocated to them. And it's going to increase their basis. But again, that's capital. When you add that social payroll tax to it, that's more capital going out the window. Just harder to raise capital as a company to do more things. I firmly believe that companies never pay taxes, they pass it along, but I also know that companies are the entity that hire people. So a trigger on capital gains could be on death, or it could be on a gift transfer, or a death. The exemption is a spouse is an exempt from the trigger. We're not sure on the AB trust planning at this point. Nothing was said. But think about that. You have, again, let's go back to that building you bought for $100,000 and now you're gifting it and it's worth $2 million to your kids. Where before they would just inherit your cost basis, and upon their death, they would then deal with the taxes. But when the transfer is made, this is when the taxes have to be paid. Grats, there was a little bit on grats. And there also, we're talking about grantor trusts, where again, when the grantor dies or the trust is no longer revocable, this could trigger the gain at that moment, not when the property is sold. And what's another alarming thing is Van Hollen's proposal. He basically can be something he can trigger to go back retroactively to January 21st. So if a transaction occurred this year, let's say in October, they're going to go back to January. I did hear the date of April also. So this is what's around the corner that we're dealing with. This really ends up, if you look at it, being an area in which life insurance becomes more important in the planning. Because we're going to create, through this tax provision, bigger liabilities and expenses on transfer and upon death. So not only are you dealing with the possibility of an estate plan or estate tax with a lower exemption, but you're dealing with income taxes also. So for an example, when someone dies owning property and it's in the estate and being taxed on the estate level, they're also dealing with the income tax of the gain over and above the cost basis. And in many of these proposals, at least the Biden proposal, they want to stop the stepped up cost basis and use the carryover. So again, that $100,000 basis upon death, now the value of the property is $2 million. Well, not only now do you have the estate tax that is going to be much higher because the exemption's much lower, but now you have an income tax on the gain from the 100,000 to the 2 million. So obviously we need capital in the estate to pay for that. Tax-free life insurance is a wonderful place. So the way we look at trusts and how we fund them in the future is going to be very interesting. But again, we're talking wealth replacement under these provisions with life insurance, and also the money to pay the taxes. Not only are we replacing it because it's been deleted because of taxes, we got to pay the taxes because real estate's not liquid. Some stocks might not be very liquid. Private companies aren't liquid. So anyways, we're going to see how this all shakes out. And I thought I'd give you a preview from what I have. So that is basically where we are. So we have a lot to work on, and I'll keep you up to date on what we're doing. And I have put, and along with this link, I have put my blog and white paper on the provisions so you can have that. Well, again, thanks so much for spending some time. I hope this is helpful to you.